Hello, everyone. Please take a seat. I know that there are still people coming in, but I think we should get started as it's a very jam-packed schedule going on. So my name is Pelle Enarsson. I'm a senior advisor and the deputy head of the UN Foundation New York office. And it's really my pleasure to welcome you all here today on the sidelines of the ECOSOC Forum for Financing for Sustainable Development. And to this discussion aimed at finding solutions to mobilize private investment for the advancement of the 2030 Agenda. We're very pleased to be co-hosting this, not just this event, but several events together with our colleagues at UNDESA from the Financing for Sustainable Development Office. Representatives from countries around the world, including Bahrain, Brazil, Colombia, Ecuador, Mauritania, Nepal, Serbia, Suriname, and others will be at the SDG Investment Fair this year. And they will showcase investment opportunities in the transport, energy, and social infrastructure sectors and network with investors attending. The exchanges taking place here also touch on the critical issue of creating the right enabling frameworks to crowd in private investment for sustainable development. We will hear perspectives from market actors, including leading financial institutions and funds active in the alternative and sustainable investment market on how to scale up SDG financing. The insights shared and new partnerships hopefully forged between business and government will be invaluable as we collectively shape the 4th Financing for Development Conference in next year and the dialogue that is needed between the public and private sector. As such, the SDG Investment Fair is a critical convener of the conversations needed now and over the next year to forge a deeper understanding of the key challenges to scaling up SDG-centered private sector investment and to help drive solutions to overcome them. And you all know in this room that these are not times that are satisfied by incremental progress or business as usual. The costs of inaction and no investments are just too high and the opportunities too great to bring anything less than our highest and best ambition to the cause. As always, the UN Foundation stands ready to support you in this effort, and I wish you all a very productive and ambitious session today. And with those few introductory words and setting the level of ambition here, I would like to invite the first panel of today. And we have as a moderator, Mrs. Shari Spiegel, who is Director for the Financing for Sustainable Development Office at UNDESA. And I would also like, so please, Shari, come up and take your seat. We have 3 other panelists, Mrs. Diane Demsky, Secretariat Emeritus and Advisor, Operating Principles for Impact Management. Please welcome to the panel. There you are. Great. We have Mr. Arsalan Mehtapar, Head of JP Morgan Development Finance Institution. Welcome. And Mrs. Asha Mehta, Managing Partner and CIO of Global Delta Capital. Welcome. And with that, I'll hand over to you, Shari, for moderating.
Is this working? Yes, okay, great. Thank you so much. And thanks to the UN Foundation for hosting this session of the SDG Investment Fair. And we don't have that much time for this panel. We're going to try to go through it quickly. And then when I have to, unfortunately, I'm going to have to run to meet with the Undersecretary General at 3:45, and Maria Katerina will take over, who is our real expert on these issues anyway, will take over from me. So for those, the background of all of this is that mobilizing private financing is crucial for catalyzing economic growth, innovation, and sustainable development. The recent Financing for Development Sustainable Development Report highlighted a $4 trillion gap in investment for the SDGs every year in developing countries, and also really highlighted the cost of capital and how difficult it is for many developing countries to access affordable financing, affordable long-term financing. So the fourth conference on financing for development, which will be held in Spain in 2025, and will really update the global framework for thinking about financing sustainable development, which the last one was the Addis Ababa Action Agenda. It's going to be an opportunity to advance frameworks that support sustainable development investments that are globally interoperable, integrate double materiality, and combine profit with impact. Sustainable finance has certainly gained traction in recent years. Global sustainable investing assets are $30 trillion in 2022, but still that's a small fraction of the total global assets under management. And of course, it continues to bypass the countries most in need. The focus also continues to be very much, though it's interesting to hear from you all of this on ESG strategies geared towards risk mitigation, where impact investing, which actually will think about the impact as well as the risk side of it, only represents around 3% of sustainable investment activities, despite growth potential. So UNDESA does quite a bit of work in this area. We do normative work. We have the Global Investors for Sustainable Development, which I think some of you are part of. And there we have, they're focusing on 3 areas right now on blended finance. How do we make it actually work and meaningful? Currency risk issues and incentives and how do we align incentives with sustainable development? That all of this is going to build on previous work, including the definition of sustainable investing, the navigator, the model mandate, and sector-specific impact metrics. And we also do engagement with global standard setters such as ISSB and the GRI. We also do research and analytics, the Financing for Sustainable Development report. I urge you to look at the chapter on private finance. I'm not going to go into the details of that for time reasons. And finally, we do technical advisory work, providing advice to member states on sustainable finance as needed. And again, the SDG Investment Fair is part of that process. So with that, I'm going to turn to the panelists who know much more about all of this than I do. And I'm going to, if it's okay, I'm going to skip all of your broader bios to just get straight to the substance. So I'm going to start with Diane. And yes, 1 second. As I'm jumping forward to save. Okay, here we go. So we're going to start with unpacking the shift from ESG to impact investment. And Diane, you've worked on both the investment side as well as an impact norm setting within the IFC, and then as part of the operating principles for impact management, a global standard for integrating impact throughout the investment lifestyle developed by the IFC and now hosted by the Global Impact Investing Network. So by way of introduction, could you also please remind the audience of the current vision of impact supported by the impact principles, including how the concepts of ESG, risk, and impact coexist in impact management?
Is this on? Yes, great. So thank you. And I'm delighted to be here with 2 friends from the market. So we've known each other for a long time. So the operating principles for impact management were launched in 2019. It was really to address the issue of what is ESG versus sustainability versus thematic investing, because it was all starting to melt together. After the launch of the SDGs in 2015, there was this exponential growth and interest in impact investing, but nobody really knew what it was. So the impact principles were created to clarify what it means to be an impact investor, what do you have to do to invest for impact, and also it provided the framework to ensure that you incorporated impact throughout the life of an investment. So to clarify or distinguish between ESG and impact, ESG is the foundation for impact, because without ESG, there is no impact. You have to monitor for the potential negative effects of an investment before you can talk about having a positive impact. But on top of ESG, there's a level of rigor required by impact. You have to have intentionality. You must target an intentional impact at the outset of an investment. You must be able to talk about contribution. Why does your capital matter to the impact achieved? And you must be able to measure the impact. So of the estimated 1.1 trillion assets in impact at this point in time. More than half of them are managed by the signatories to the operating principles for impact management. So we are actually tracking this trend and seeing strong growth in the impact market. Part of that is due to the impact principles, because once you had a standard, people knew what they were trying to invest against. So it really helped mobilize capital, which was one of our goals in creating them. But what we're also seeing is there is an annual disclosure statement requirement. So every signatory must publish a disclosure statement in which they describe their impact management practices and also declare the assets they have under management targeting impact. So from the existing signatories, we've seen tremendous growth over the past 5 years. But more importantly, we're seeing many new entrants into the market. We're seeing huge growth out of Japan, out of Singapore, out of Latin America. And it's all sizes and types of investors. In particular, the highest growth segment that we've experienced on the signatories is the VC market. Venture capital funds are targeting impact at a very high rate, and that's global. That's not just here or in Europe, it's everywhere. So we are very heartened to see this incredible growth. We started with 58 signatories and 320 billion, I think, in impact assets. We now have more than 530 billion in impact assets amongst 183 signatories from 40 countries. So it is definitely growing, and it is clear what it takes to be an impact investor.
So why do you think VC is becoming more and more interested in?
They were always there, but I think because so many were just beginning, that they were like, can I afford to be a signatory? Can I do this? What are the resource constraints? But increasingly, what we're hearing from the VC space is, we're getting pushback from institutional investors saying, you're impact washing. You don't have the data we want. You don't have this and that. And they're like, but we do. They're actually true impact investors at the core. So they find that being a signatory actually gives them credibility in front of their investor base. They said, okay, we might not have that data because we're investing in healthcare, in preclinical trials, so we're even out before the actual impact achieved, but they need that initial capital. So being a signatory, they say, we have this disclosure statement, we're providing you independent verification, that's another requirement, so they actually, it helps them raise more capital amongst the base.
And would you say that more and more venture projects are just naturally that there's profitability in being aligned with ESG? Like how, because obviously there's a reason that it's fitting in with their strategies.
Well, it's not ESG, it's beyond that. It's impact.
Beyond, sorry. Bad language.
Yeah.
Yes, impact, right.
They are good. That's a great conversation to have. So yeah, no, they're targeting impact. They have the highest impact probably of any type of investor. They are putting capital where capital doesn't exist, and it's so needed. The pre-seed, seed, early stage. And I tell you, I love talking to that universe. They are so passionate because what they're doing, they're putting all of their blood and life into what they're doing. Yeah, it's very inspirational. Yeah.
Great. And then finally, do you see any specific themes, sectors, et cetera, that would be most interesting in this space going forward?
Yes. Well, I would say by and large, most investors in impact are targeting emerging market and frontier markets, most of them. Doesn't mean the largest size, but they're all targeting it. Most of impact investing is still occurring in the private space, so private equity, private debt, loans. Increasingly, we're seeing publicly traded debt in impact portfolios, but that's mostly green bonds, social bonds, sustainability-linked bonds. And there is a market for publicly traded equity impact investors, but it's really challenging to demonstrate intentionality and contribution. But again, this is a young market. As it matures and as it grows, more best practice will emerge, so we're going to be able to mobilize more public as well as private capital. But for this audience, what I've been doing, I'm stepping down as head of secretariat, which is why I'm emeritus. So my parting gift is to do some signatory analytics. This will be a public good, posted on our website by my colleague Henry very shortly at impactprinciples.org. But among them, we've asked people, where are you investing, how are you investing, and what are the SDGs you're targeting? So out of 183 of our signatories, it's really interesting. Almost all of them are targeting 1 up to 5 or 6 of the SDGs, but there's definitely a convergence around 2 of them. SDG 3, decent work and economic growth, where 50% of the signatories are targeting that. And increasingly climate, SDG 13, over 40% are. Now there's a grouping of 30% for most of the other SDGs, but I have to highlight very underinvested. The most underinvested is, sadly, the ocean and blue economy, life under the water. And if we don't have a healthy ocean, we don't have a healthy planet. So we have to mobilize more capital for SDG 14 and also life on land, SDG 15. Those are the two unloved, underinvested SDGs. And it's really important. It's critical that we move more money to this space. But that will be on our website. So please stay tuned.
Thank you so much. So Arsalan, the establishment of JP Morgan DFI is an example of a mainstream institutional investor venturing into this space. I think that you are focused on, well, I'll leave it to you to talk about what you're focused on. So the question really is, what is your mandate as a start? Maybe just start there to talk about exactly what your mandate is and how you may be similar or differ from some of the impact investors that, well, yeah.
Sounds great. Well, this is on, right? Okay. Well, I'll kind of pick up where Diane left off. Where we at JP Morgan, where we play is in the public capital markets. That's, we're the largest investment bank. JP Morgan DFI sits in the investment bank, and an investment bank is a sell-side institution. So we're not an end investor. We're an intermediary between the users of capital, which might be either corporations or governments in emerging markets that want to raise financing, and then end investors who want to put their capital for positive impact, such as the OPIM signatories, but especially those that want to do so in the global capital markets. And that's where you get the big numbers, right? So the 30 trillion number that you mentioned, Shari, in 2022, which I think as recent as 2024 was even estimated to be 40 trillion, is majority ESG integrated. So they're looking to do no harm. And the way they do it in the risk management process is that they, have these screens. Okay, I'm not going to invest in a fossil fuel company. I'm not going to invest in anything that has high carbon intensity. But then when you see where that money's going, where's it going? It's going to Facebook. It's going to Google. It's going to, tech companies, PwC, Accenture. It's going to companies that just don't have emissions by the nature of what they're doing, rather than going to places where it's needed most. So my mandate is to help those investors, especially those that are graduating from ESG integration more towards impact strategies and becoming open signatories, to find in the public capital markets opportunities for investment that is going to have impact on the SDGs where it's needed most. Bring food security, health, education, gender equality, financial inclusion, all of them that you can think of. We're working on life and land and underwater. It is the hardest because we are doing this on a commercial basis. So it has to bring returns and it has to have impact in order to be eligible for that impact investors portfolio. And therefore, that's probably one of the reasons that people have yet to be able to monetize land and ocean conservation. And it's probably one of the reasons that it's less reflected in the numbers.
Great, thanks. Could you also give us a flavor of the SDG themes and sectors of your investments today, as well as key geographies?
Sure. So I would say from a geographic perspective, and we cover global emerging markets, I think it is reflective of what the markets are doing at the time. So last year we had a lot of transactions in Latin America. I think investors were a little bit more risk on Latin America. When we started about 4 years ago, it was more in Central Asia. But after the war in Ukraine, I think that region, people were a bit risk off there. India and Brazil are, I think, now two big emerging markets that are growing. So, and then Africa has always been a group that we work on. But again, as JP Morgan, we can't really operate in the places that are the most frontier markets. So you won't find us in, Zambia, but you will find us in, South Africa or Kenya or Cote d'Ivoire or, Gabon or, countries that are at least lower middle income or middle income and above, which I think is complementary to the ecosystem, right? If we can help the financing of development in those middle income countries, then the official development institutions that are funded by, public sources of capital, and then reallocate their capital to the more frontier markets where the private sector might not go in. And then thematically, it's been infrastructure, I think, digital as well as hard, transport infrastructure. It's been financial inclusion. It's been energy. But just one last thing I want to mention, because I think it's an important part, is that the current channel to accessing impact capital in the public markets is, as Diane said, these more use of proceed type instruments, green, social, sustainability bonds, et cetera. The innovation that we brought to the market was to say, if you look at those instruments, emerging markets actually only account for less than 10% of that, if you take especially China out. So we saw that as a big binding constraint. What we did was help entities to measure their impact at the entire entity level. So they're not constrained by the size of projects if they're doing it at the kind of complete corporation level or at the complete government level. And by doing that, we are able to bring about $20 billion of impact investment opportunities to market every year. And now we're actually working with industry partners to turn this into an industry standard to level that up to about 200 billion per year.
Sorry, so I'm going to show my complete lack. Could you give an example of, like, a client comes to you, what they're looking for, take us through the whole process.
So a client, let's say the government of Costa Rica comes to us and says, I need to raise $3 billion this year to finance my government budget, right? They come to us, and normally what JP Morgan would do, that'd be a sovereign bond. We would underwrite it, we would offer it to institutional investors, and we would sell it down to 100 investors. One takes 10 million, one puts a $30 million order, when it will syndicate it amongst a list of investors. Now, what we would do is, when my team gets involved, is we would work with the government in Costa Rica and say, what are your national development priorities? And they have many. They already have a national development plan. They have, priorities for climate transition. They have priorities for cash transfers to lower income households. They have priorities for improving health, education, the whole gamut. But what they don't necessarily have is an impact measurement and monitoring framework to measure the success of delivering on those national priorities with specific and measurable metrics and targets that are material from a development and SDG impact perspective. What my team does is first work with the government of Costa Rica to develop that impact framework. So that's one. And then second, when the bond is being marketed to institutional investors, my team reaches out to an incremental 50, 60, 70 investors that we know have impact criteria. And because of that framework that we help the government produce, they now might be eligible for those impact portfolios. And we end up crowding in an additional 20% of liquidity into that bond that otherwise wouldn't have come in if it were not for that framework. So that's how we're crowding in impact capital into.
Great. Now I finally understand exactly what you do. And so would you say most of your deals are the sovereign deals? Or?
No, actually, there could be also a telecom company in, we did one for a telecom company in Madagascar that was operating in 12 sub-Saharan African markets, and they were, raising capital to expand access to internet in Togo, Tanzania, and Uganda. It was with, just yesterday, a bank in the Republic of Georgia that was going to use the capital to on-lend to SMEs and to renewable energy sector. So actually only about 20% are sovereign. Then we have several that are sovereign, state-owned enterprises, but they're commercial enterprises.
Something like the on-lending to SMEs, would they come directly to you? Would they go to JP Morgan and JP Morgan sends them to you, says you might be a good fit for our development finance institution?
We kind of go together. So, we have bankers in 100 countries across the world. And so the banker that covers Georgia is, if you look at his schedule, he has weekly meetings with the CFOs of the largest companies in Georgia and is telling them, what are your needs in order to grow your business and in order to serve the underserved, to grow your business.
Right.
And what he also says is that if you want to go to the market and you want to raise capital, if you actually have a strategy or plans to serve the underserved and kind of address SDG gaps, I can involve my DFI team and they can help when you go to market.
Great. Okay, good. Thank you so much. I'm going to go now to Asha. So you are the co-founder of a women-owned business specializing in emerging market and frontier markets. You bring a unique perspective on all of this. So how has your journey been shaping the transition from ESG to impact, particularly from a listed equity asset class perspective? And could you also elaborate what impact means and how it materializes for this asset class as opposed to private strategies, as an example?
Thanks, Shari. Yes, of course. I'm so happy to be here. Thank you, everyone, for attending, and thanks so much for having me on this panel. It's such an interesting discussion. I think Diane and Arslan, you guys have covered so much of what's critical and topical in the impact space. So I'm happy to jump in with some additional views, and I'll try my best not to be repetitive because I agree very strongly with all of the themes that have been raised. Just to give a little context on who I am and what I do, what my firm does. I'm an investor in institutional emerging market equities. So I'll try to round out the conversation a bit by talking about the public equities perspective. I've spent about 25 years in this space, started my career as a banker at Goldman, went on to oversee about 25 billion in emerging market equities before launching my own firm. And while I was with my prior shop, I also brought the firm to be the first systematic quantitative investor to sign the PRI. So I bring this up in the context of bringing up a couple novel points. One is the role of systematic, data-driven, technological, the fact that we live in the data age, the technology age, and what does that mean for our objectives here as impact investors? And Shari, to motivate your question around ESG and the transition from ESG to impact. Having been one of the first signatories of the PRI, I've been pretty involved with the ESG space for quite a long time, and I've seen this transition occur from what was once SRI to ESG, which I think is still somewhat ill-defined today, to impact, which is even more poorly defined, except for the great work that Diane has done. But as an industry, it's a space that really I think is still coalescing around what does standardization of impact measurement look like. One other piece about my background before I dive into the transition from ESG to impact. I'm also the author. I published a book a couple years ago with Wiley called Power of Capital. There's a copy of it sitting over there on the counter, and it's stories from the ground. I start in China, I go to Vietnam, Saudi Arabia, one country to another, and tell stories about what it's like to be an investor within these markets who is looking for market returns. In fact, we're striving for returns that are very competitive, that will bring impact at scale, that will bring us investors who are looking for competitive returns, because we believe that the impact or the sustainable space will only be sustainable if it's offering compelling returns associated with it. So the book, Power of Capital, talks about a number of stories from across the globe around how investors can deliver both alpha for investors as well as impact. The transition from ESG to impact is palpable. I said ESG is somewhat ill-defined. I've heard this panel reference it several times in the context of risk mitigation, and I think that is probably the most common application of ESG. I look at ESG somewhat differently. I look at the integration of ESG as more thinking about how these externalities, exogenous, non-financial concepts will impact portfolios. So that could be either return-driven or risk-driven. So it could be either mitigate risk, or it could be, companies that are well-managed will tend to outperform, or companies that treat their labor forces well will tend to outperform. It can have sort of that growth or positive component to it. Impact, on the other hand, is less about, how are these externalities impacting your portfolio, and more about how is the capital you're investing impacting the companies or the communities in which they operate. And so that was sort of the thinking and the thesis behind the formation of Global Delta Capital. We're a systematic manager focused in emerging markets, committed to impact and aligned with the SDGs. We invest across the SDGs, including the beloved SDG 14 and 15. I will accede that it is fair and consistent with my own views that 14 and 15 are underfunded. Again, through the context of a public equities investors, there's just not a lot of companies out there that are making it to the stage that they can, issue an IPO in the public markets. And ultimately, we're looking to invest in companies that are either post-IPO, they're listed on an exchange, or they're just before that stage. Sort of two mega themes that I see available to us today, private sector investors who are looking to achieve the objectives that align with the public sector. One is the fact that private sector investors today have this mandate, that ESG has gone so mainstream to the effect that there's actually a backlash today, And those investors who have stuck with ESG, I really see them going deeper. They're saying, we want more than just ESG. We want you to deliver on impact. And that, to me, feels like an evolution in the industry, that investors are truly funding impact today. And number two, this point around data and technology and what that means for transparency. Diane mentioned many impact investors and emerging in frontier markets. I've been active in frontier markets for about 20 years. And I was on a trip to Romania where I met with the head of the IMF. He was so excited to meet me, and I was so surprised because usually people aren't that excited to meet me. And I asked him sort of what was behind that. He said it was because I was a public equities investor, that typically, investors who are taking meetings with IMF and other sort of multilaterals, it's those that are looking to fund private projects or on the credit side. But his view is that in the public equity space, we're able to take advantage of the fact that public markets offer unrelenting transparency. And that if we can follow the sources and uses of cash, if we're forcing companies to share information around how they're operating businesses, not just on an annual basis or even a semi-annual basis, but quarterly, that is the best way to drive results. And that's sort of the power of the equity markets, is the data and the transparency that comes with it. There's so many challenges that you touched on related to how do you measure impact in the public equity space. But not lost on me, we're sitting in the Nelson Mandela room, and when I found out we were going to be in this room, I thought of the quote he shared, it always seems impossible until it's done. This idea of investing in public equities through impact, it's incredibly scalable, and it's a solvable problem of how do we measure impact through the asset class.
Great, thanks. So Diane, maybe that's a good segue to talk more about this idea that when the Global Impact Investment Network called for establishing principles for impact practice in 2018, they was really looking to stop impact washing. And would you say that the impact principles, that how do you think these principles are carried out in practice? And are these age-old concerns growing or decreasing? And are you seeing more convergence in impact practices?
Well, to answer your first question, yes, we're seeing more mitigation of impact washing, which is the good news. So the impact principles were, again, written to provide a standard, but what they brought, because of the two requirements of the annual disclosure statement that every signatory has to publish, and the independent verification, which means there's an independent party that's affirming that you are in fact doing what you say you do. So you just can't claim it, it's got to be verified by someone. So those two pieces have brought so much transparency to the market, affirmed the rigor of the practices, and the verification, the independent verification, has really brought integrity and credibility that wasn't there before, because it's all out there in public, on our website, on everybody's website. So that has really mitigated the risk of impact washing. It's still out there, it's still possible to do, but it's very hard because you have these standards and practices out there now. So we're pleased that the impact principles have brought the market thus far. We still have a ways to go. It's still a young market. So that's the second question of, are we seeing convergence in practices? Absolutely. One of my other parting gifts is to draft up the common practices that we're seeing on how you implement the impact principles. How do you actually implement the different pieces of an impact management system? So we're seeing around the theory of change, aside from the SDGs, there's a lot more specificity about specific things that people are trying to reach. Sometimes they go into GHG. In climate, we're seeing a lot more specific theories of change, and I think that will continue to get more sophisticated as we get more granular in certain markets. On metrics, there is a convergence around IRIS Plus metrics from the GIN, and that's mostly used by the private sector, and then HIPSO is the Harmonized Indicators for Private Sector Operations for DFIs and multilateral development banks. But they have a huge overlap, and they've worked together to make sure that these metrics are consistent with each other. We don't need another set of metrics. There are always bespoke metrics, and that's fine, but these two alone can cover the entire market. One thing unique to impact, and which is our principle 3, is contribution. Okay, you have financial contribution, but the non-financial contribution in impact technical assistance, engaging with boards, being on a board, engaging with stakeholders, engaging with the beneficiary community, doing capacity building, also industry building. Those are all ways of impact investors contribute beyond even their investments to the greater impact community. And that's really kind of that's unique to the impact space, I would say. I would say if you know Impact Management Project, which is now hosted by Impact Frontiers, they launched the 5 Dimensions of Impact many years ago, and it is one of the most brilliant frameworks. It's so simple: who, what, how much, risk, contribution. That helps you lay out your entire impact management framework, and that is probably the most widely used framework in the impact market today. The 2 areas that I will mention, which are still their convergence in the works. One is alignment of incentives with impact, just as you align incentives with financial returns. This is something that we ask for in Principle 2. It's a work in progress, and it's coming along. It's not just about carry. It's about, there's a qualitative aspect in the impact market of how you align incentives. Are you a team player? How are you building your pipeline? How are you actually working with your beneficiaries? So those incentives and that whole best practice is still emerging, but we're seeing a lot of progress over the past 5 years. The one area that's still very difficult is responsible exits. And again, if you're in public equities, that's going to look different than if you're in public bonds, if you're in private equity, if you're a direct, indirect investor. So we're pushing our signatories and we're pushing the market, but that's still an area where, be patient, we'll get there, but it's a work in progress. But those are the specific best practices where we're seeing a lot of progress and where we're seeing progress being made and more where we have to go. But I'm very heartened because what a difference from 5 years ago.
Right.
It's great.
Great. And so, is this on or off? Okay, on. Great. And it's really interesting because when you talk about so many of the standards you talk about, and the same thing, obviously, with non-financial impacts of ESG risks, and there are things that are for every profitable business and company that's well managed should be doing these things. This is not just about impact. When you talk about team playing, well, we want to do that in the UN. We don't do it well enough, but that's, so just to really note that this convergence between, and why so many of these things will end up being profitable is because so many of the ideas are really what everyone should have been doing all along. But I'm going to ask the last question to the 2 of you, and then I'm going to pass the mic to my colleague, Maria Katerina, who's going to take over as I have to run, but I want to give you both the chance to at least to respond to the last question, which is really just about impact metrics. So Arsalan, how are you doing that at JP Morgan? And then also for you to also talk a little bit about that. And so, sorry, thank you all so much for engaging in this conversation. And Maria Katerina, please come and take over.
So the way that we're approaching it, and again, the role we play in the value chain as a sell-side institution is helping the investee produce the impact information that will be needed for someone like Asha, who's then analyzing that information to see if that company issues equity, if the equity would fit into her portfolio, or if any of your open signatories might want to invest in that company. So to help them with that disclosure, we have a methodology we created together with the IFC, because we said, hey, look, development banks have been doing this for decades. They're probably the best source of figuring out what would be manageable for especially an emerging markets entity to disclose, rather than a set of maybe principles that might be drawn in Europe for corporate disclosures for European companies, which is, again, fit for purpose for that environment. So it does first start with identifying the development gaps. And the idea there is that, look, you just can't say, hey, I'm a healthcare company, so I contribute to SDG 3. It's like, no, well, if you're a healthcare company, you operate a private healthcare clinic in Switzerland, that may not have a contribution to SDG 3 because that the targets under SDG 3 might be already met there. They've already reached the threshold that they need to reach by 2030. So first, it's finding where is the gap. Then the second point is, what is the intention? Are you actually intending to improve outputs and outcomes that are going to address those gaps? And then if so, can you measure it? Are they specific and measurable? And then are they ambitious? So are they a incremental to the baseline, or at least a counterfactual to what would be if you didn't take action. The specific metrics were actually kind of flexible. To Diane's point, you could use IRIS Plus or HIPSO, which is a subset. You could use SASB metrics. We actually give people the ability to be flexible on what metrics they choose. It's less about standardizing the metrics. It's more about standardizing what is called the materiality assessment. Why are those the 20 metrics you as a company chose? You have to show that it's addressing the gaps. It's important to your local stakeholders. It's important and core to the business and the sector you're operating in. So that's the process that we have. And then the last piece that I'll mention is that we want to make sure that they're covering both positive impacts and negative impacts. So, it's not just one side of the story. Every company has negative impacts as well. But what are they doing to mitigate them? What are they doing to uphold the minimum safeguards? And ultimately, when they have both of them together, you can say this company is managing their business not just for profit, but also for impact. And they have a framework to track how they're maximizing their positive impacts and minimizing their negative impacts.
Beautiful, so interesting. And I enjoy this question so much because, again, this is the challenging space around impact in my view, right? Intentionality, it's good, it's not easy, but it's one thing to come with a big vision, and the challenge is often in the implementation and the measurement against this. And I've really enjoyed the points you guys have made because I feel like it speaks toward convergence, which is so exciting. We utilize the IMP framework, and specifically, this framework that I think is adopted here around 1, intentionality and alignment, 2, what is the contribution, and then 3, what's the measurement behind that. In terms of measurement, again, it's the measurement relative to our contributions. We, as a manager, see ourselves in contributing 2 ways. This will echo Diane's comments. 1 around financial additionality, simply being a funder of the SDGs in capital-starved markets. That in and of itself is a form of impact. And number 2, to Diane's point previously, around some value additionality, right? How are we contributing in terms of utilizing the data sets and the technologies we bring and working with exchanges and industry groups to help to drive convergence and adoption of these principles. Specifically, Arslan, really enjoyed your points around identifying the gaps, right? That we've converged, I think, as an industry around this framework around intentionality and the contributions, but what is the data item itself? That often is very bespoke, whether that's for the investment itself and certainly for the objective. Like I said, we target the SDGs, so even within the SDGs, we've got bespoke indicators that we're following to measure our own adherence. Ultimately, we're doing this across the breadth of our assets. By being a data-driven quantitative investor, we can hold hundreds of securities. And so one of the lenses we're looking to bring to this is this notion of impact at scale. That as an investor, how can we invest in more than a handful of companies, but how can we apply this? I made this point before in the context of public equities, but ideally across multiple regions, sectors, and many, many companies as well, because given the amount of capital that's required to fund the SDGs, we're going to have to look across a very broad, wide spectrum of assets. So when I think of measurement, it's measurement across a broad universe, and this makes validation quite challenging. There aren't that many organizations that are covering such a broad universe. So it opens up a whole nother set of questions, but broadly, we're reporting against our exposures and how aligned they are with the SDGs, and we're reporting against our involvement, our partnerships, to reflect more of a longer-term commitment around improved commitments and adherence to these principles.
Thank you so much to both. And yeah, sorry again about the change, but hi. Hi, everyone. But no, thank you so much. And in fact, when you were both speaking, I was really just thinking that this, first and foremost, to me, shows how much we are moving to speaking the same language. From a UN also perspective, to hear all of you just speak of the SDGs, speak of what it means to have impact, additionality, intentionality. So even just this means a lot, and it is a new field. You've reminded it, Diane. So it's great that to hear you speak like this and to have these initiatives from the private sector itself that are based on the SDGs and translated into the common language that we can all speak, including with the private sector. So thanks for these nuggets of wisdom. And just to conclude, because I think we're a bit over time already, and we need to move to the other panel. But thanks so much for all your perspectives. I mean, we've heard that impact investing is growing, which is good news, even though we have a bit of an uneven distribution across some SDG themes, across some asset classes. So we need to, double efforts on those SDGs that are still missing and try to fill those gaps. We needed to scale. So this will be a great segue for the second panel in realizing that, we need also maybe legislative frameworks to help it to scale. And in general, the role of sustainable finance legislation has, I believe, and we believe at the UN, a big role to play in bridging those gaps where the private sector is still not there, and to, drive even more harmonization on top of the voluntary convergence that we're already seeing on markets. So thank you so much for all three of you for your contribution. Just before you leave the stage, one last point that we haven't mentioned is that we've created a Slido with, so you can see it on the slide, because we'll only have one Q&A session at the end of the two panels for timing reasons. I think it's clear to everyone. So if you could, send in your questions if you have any through Slido. So you just connect on the Slido website via simple Google search, and then you enter the link that you find on that slide. So you can ask our panelists some questions, and we'll take them at the very end if you three wouldn't mind staying with us. Thank you so much. Thank you. Can I now invite our panelists for the second panel up on stage with me? Thank you so much. Thanks for joining us. So just to bring a little step back here. So hi again, everyone. Thanks again, everyone, for joining us both in the room and online. So we hopefully will have an interesting second panel here. We'll try to respect timing, and I'm looking at my colleague here as much as possible, even though we're already very late. We are very happy to have a diverse panel here and some brilliant panelists that I'll present in a minute. Just before that, let me give just some very quick context and introductory remarks to frame this panel. So we've now just explored just now how impact investing is growing and how important it is to really get private sector investing on the SDGs and for real world impact, and not just about risk mitigation from an operational perspective. We will focus here on how to facilitate this through policy, as I've said earlier, and really how to create the right enabling environments for impact investing to scale. We recognize the need for a level playing field for that to happen, with harmonized rules to ensure clarity of direction and really show the way to transition in key economic sectors, as well as avoiding risks such as greenwashing and impact washing that we've talked about earlier. And as Diana was mentioning earlier, to align incentives. We have this still some gaps on incentives that we need legislation to fill. In this year's Financing for Sustainable Development report, we have emphasized that to do this, to level this playing field, we need to really work on two levels. So those are both tackling issues within the sustainable finance field itself. We've just talked about them, be it definitions, methodologies, data infrastructure, and simultaneously address some of the systemic barriers that we're still seeing that still favor traditional investment and restrict systemic scale for impact investing. So this really requires, we believe, a holistic and whole of government approach. So these are big words, just to say we need to work together. We need environmental ministries to work with financial ministries. We need to, really have a holistic approach to impact investment that doesn't just stay, a niche environmental practice or social practice, but rather, scales up throughout the government. So the good news here is that we're on the way. We're seeing some change. We're seeing some maturation. We are currently witnessing a growing convergence of voluntary standards, but also more and more legislation. So we have seen, a big rise in these frameworks over the past 3 to 5 years. Just very briefly, we have different categories of these types of legislations. We're seeing mainly those that are guiding alignment and alignment of investments with sustainable development objectives that are taxonomies. We're seeing those that are addressing gaps in disclosure, that are disclosure legislation. We're seeing some that are enhancing data and product reliability, namely greenwashing legislation. And then we're also seeing some that are harmonizing investor stewardship. So namely the EU CS-DDD today was just passed, and I'm mentioning the EU because we don't have it on the panel. So another legislation that was just passed today, which is great news. So this panel will aim to showcase examples of good policy and regulatory measures across also emerging markets, right? That was our aim here, and we really hope that with this panel we can inspire maybe a few of you in the room or online to follow suit and to say that it's possible to do so, and to really hear from our panelists how they've done it, and to replicate these. And finally, and I'll then shut up. Additionally, we'll explore how we can collaborate to make sure that these frameworks that are being adopted right now are interoperable, and that we don't fall into a trap whereby international investors or others will have to report on so many different ones, because if they operate across geographies. So really believe that also this interoperability, this global cooperation will be key. So with that, I'm very pleased to welcome our three panelists from different regions, and this was really on purpose. So welcome all. We have Felipe Noval Acevedo from Latin America, from Colombia specifically. Do you mind if I also skip the bios following my boss's lead? I wish I could, but I'm afraid that then we'll eat too much of the networking session. But Felipe is Felipe Noval Acevedo, I want to pronounce it correctly, is Senior Deputy Superintendent for Financial Intermediaries and Insurance in Colombia. So yeah, we'll be speaking with you about your taxonomy and these topics today. Then we have Puye. She's the Chief Representative of the New York office of the Monetary Authority of Singapore. So thanks for joining us. And then we have Layali Ramahi. She's UNEP FI's Regional Coordinator in North America. So thank you all for joining us. And without further ado, let's start with Layali at the very end. Last but not least, UNEP FI has been one of the first, if not the first, norm setter and standard setter in sustainable finance from the 1990s, way back when. Could you provide us a brief overview of how your perception of this evolving from voluntary standards to the mandatory legislation is, and if you could give a bit of flavor on, are we really seeing legislation for impact beyond ESG, and what does that look like?
Well, thank you. It's great to be here. I'm going to pick up on where the conversations were to try to get us back on track and have networking. I think that's what everybody would like to see. I think taking a step back or a zoom back in terms of what we discussed today and where we're going to get at. As we said, it's how did this evolve? Where did we come from in terms of identifying impact investment, or how did we get to ESG investment? It started back from even the early 90s in terms of deciding what we want to do. It's voluntary frameworks. It's investors that come together, want to set the definitions, want to allocate capital where capital is needed. It started from philanthropy, and impact investing started with a concept of wanting to do the good thing for the good thing rather than a financial return. And gradually that evolved into there's a risk element and there's a reward element, and gradually we can see capital being directed towards these opportunities, and adding an impact comes in terms of the definition of the buckets of where the investment cycle is. Are you in ESG? Are you just screening? Are you avoiding risk? Are you trying to minimize that risk exposure? Or are you moving towards, no, we want to include that impact addition that wants to be included in that portfolio? And I think through that evolution, we've seen the problem that started to emerge in the market, not because there's a lot of interest, or if we focus on the ESG backlash, but maybe we focus on the ESG washing or the impact washing. There was risk. You are seeing a lot of labels, but you're not seeing the real impact on the ground. And that was clear in terms of the SDG investment gap, or the impact investment gap, is growing. Then there's a mismatch in terms of what we are saying where capital is allocated, but in reality, what's happening on the ground. So I think there's the regulations started to evolve from voluntary that set the market. It's a ground up-led approach in terms of the market deciding where impact should be and what the frameworks look like. And we saw the evolution, which is gradually has been excessively growing, as you mentioned, towards regulation. And I think that regulation comes to plug that gap, that problem that we have in terms of the short-term and the long-term consequences. And this is where we need to define impact, more or less. It's short-term decisions that affect the long-term outcome. So we're seeing growing legislations, in particular, as you mentioned, in the identified buckets in terms of alignment. So what do we mean by alignment? It's not just only, how I like to describe it, it's not just only about adding impact or legislation based on impact, but it's how you increase the pie itself, how you increase that piece itself by broadening what that definition is, not just only attracting new capital, but reassessing and redefining where the entire capital in the market is. So that unlocks trillions and trillions in terms of where the money should be. So that speaks to the language of what the business should do and where the money should come and flow. The second is disclosure. You can't have impact, you can't measure impact if you don't have data. So I think that's the biggest definition in terms of where the regulation is going. And the regulation was mainly specifically focused more on the risk aspect in terms of what the companies are exposed to, opposed to what the companies are doing. But that's a gradual movement in terms of the regulation frameworks. And I would like to say that it's promising that where the regulations, the jurisdictions, the growth was faster in terms of jurisdictions from developed financial markets, developed economies. That was the start because the markets were more mature. And we have seen bigger issues coming to rise faster. But we have seen massive and great regulations coming from developed markets. And they're now around the 60-40 addition, let's just say, between regulations. But very promising and growing trend in terms of market progress on that sense.
Thank you so much. Yeah, a lot to unpack there. One of the, just guess taking from your last remark, very interesting, this perspective of 60-40. I mean, we do also see it, definitely driven by developed markets, but with developing markets and emerging markets definitely, coming in strong now, and we'll hear more about that. And in fact, it's a great segue on my next question to Puye. Singapore is often cited as an exemplary market in creating the right enabling environment for impact investing. I think your Minister of State of Trade and Industry said Singapore is to be Asia's leading sustainable finance hub. So can you tell us a bit about, what that means in Singapore? What are the policies and incentives that you've put into place? And as well, like going back to Leila's point, what are the kind of capacity constraints that you're overcoming to do that? And if you could tell us a bit about your.
Thanks so much. So I think maybe where I'll start first, right, is to explain why is sustainable finance so important to us in Singapore. So within Asia, we're home to 70% of the global population, basically, that is susceptible to the sea level rise. And a huge population, ADB estimates to be about 150 million people, don't even have access to electricity yet, right? And there remains a significant investment gap of 1 trillion every year for us to reach net zero by 2050. Asia also accounts for about half of the global GHG emissions, of which a third actually comes from coal-fired power plants. And we're still very dependent on coal for energy. Nearly 60% of the power generated in the region actually comes from coal. And our energy demand is actually projected to actually even double 2.5 times by 2050 because of economic growth, population growth, and urbanization. And I think what adds to the challenge for us in Asia really is that it's a large region and it's not homogeneous. The scale of this problem is really too big for just one country to solve this problem. The good news is that we have a strong base of like-minded partners and good actors who actually want to catalyze Asia's net zero transition. Right. So how does the Monetary Authority of Singapore actually come into all of this? most people know us as the central bank and the financial regulator. But what a lot of people don't know, what is lesser known, is that we actually work very closely with the industry and with fellow government agencies. Like you were saying, the Ministry of Environment, etc., all needs to come in, right? So that we can develop the financial sector in Singapore and see sustainable finance become not just a tool that people invest in, but really seeing impact and good being come out of all of this, right? So I think our unique position really gives us that leverage that we can convene everyone to come together, and when we can come together, that's where we can make a big difference. So you're asking about how policies or incentives, how we've been using that really to advance the sustainable finance or impact agenda in the region. I'll just share two examples in the interest of time. So the first will be on blended finance. You've made notice announcements at COP28 on the Financing Asia's Transition Partnership, or FAST-P in short. And basically, the Singapore government has actually indicated that we are prepared to contribute concessional capital to support this partnership, right? And we hope to mobilize a base of concessional capital for this platform, working together with philanthropies, MDBs, DFIs, really targeting the key themes of green and transition investments that are most pertinent in Asia, right? From the managed phase out of coal to development of renewables, to the modernization of grid systems, etc. We've gathered a strong cast of initial partners, the likes of ADB, IFC, GAP, Temasek as well, right? And we aim to mobilize up to 5 billion to de-risk and finance transition and marginally bankable green projects in Asia. Layali mentioned about how the genesis of impact really is because of philanthropy, right? And this brings me to my second example of philanthropic capital. There's been a growing space of wealth in Asia, particularly in Singapore. And we've really seen an increasing interest among family offices in particular, with the involvement of next generation members in sustainable financing and giving towards climate and impact, right? And so it's really important that there's, from our vantage point, it's really important to have a supportive environment such that we can help people really achieve catalytic impact, right? And so one example of what we've done recently is to enhance some of the tax incentives that we have. So we recognize grants to blended finance, for example, blended finance structures as eligible spending, so the incentive recipients can meet spending requirements, and they can also choose eligible climate-related investments or blended finance structures in Singapore as options to fulfill some of the capital deployment requirements as well. There's a lot that we're doing. I won't have time to cover all, so feel free to reach out after this during the networking. I'll be happy to share more.
Can you just maybe quickly, I mean, very interesting, and thank you so much. You said some of the maybe more fiscal advantages that you have for impact or philanthropic investor. Could you maybe touch a bit about that?
You mean fiscal as in?
Some of the, I know, for instance, your SCORE program, is that one thing that would enter through that, or?
So what we do in terms of developing, the ecosystem, right? We use this acronym SCORE. We talk about skills, community, opportunities, resources, and environment. So there are various initiatives that we do, in relation to, for example, upgrading skills. We actually just launched our jobs transformation map, where we did a study together with external partners to really identify where are there skill gaps, and how can we, work with other institutions, whether it's IHLs or associations, right, to plug the skills gap, introduce new courses, etc., so that this is not just so that we can cover all aspects of impact of sustainable finance as well, and then community opportunities. All these are important ingredients, right, so that we can all come together to advance this agenda.
Thank you. Yes, I didn't want to put you on the spot there, but I mean, Singapore is a great example of creating this enabling environment. So I really wanted to underline it. I think you have some great measures. And I mean, you touched upon blended finance being, how can governments have these public-private partnerships for impact, and Blended Fund is a great example of that. So yeah, thank you. And now that we've set this larger stage with some wide measures and this whole of government approach, let us move to Felipe. So we know that Colombia has been the first country in the Western Hemisphere, I was reading a while ago, to adopt a green taxonomy. It was often cited as a great example and a great first mover in this space. So can you tell us a bit about your green taxonomy? First of all, for our audience that may not know, in 30 seconds, maybe summarize or define what a green taxonomy is. And then very quickly, what was the driver of Colombia becoming one of the first countries to adopt this taxonomy?
Sure, is it working? Yeah. Okay, first of all, thank you for the invitation. For me, it's an honor to be here and to share the Colombian case, our perspective in terms of sustainability and the public policies around it. I want to share that first the Colombian Financial Superintendency has two main responsibilities. From one perspective, we are in charge of all the supervision of the financial institutions, but on the other hand, we are responsible to promote the capital markets. In that sense, 4 years ago, we did a survey in terms of climate risk and opportunities. And we find out that most of the actors and players were demanding for common understanding of sustainability and environmental policies. They wanted to create some standards, a common definition, taxonomy, some green certificates, in order to promote and to bring more capital from local and international players. And that's one of the main reasons that Colombia started to working on its own green taxonomy. But about the main reasons, I would say that there are two main chapters. First of all, Colombia adapts under local law different kind of initiatives from the United Nations framework on Convention of Climate Change, the Kyoto Protocol, the Paris Agreement, under the local law. And we have to comply with that kind of responsibilities and initiatives. But also Colombia has its own agenda to develop different kind of sectors on initiatives, such as climate change mitigation, climate change adaptation, ecosystem and biodiversity conversion, water management, soil management, circular economy, pollution prevention and control. So keeping in mind that there were these kind of reasons, Colombia started to look at the international perspective and good practices on different jurisdictions. So we saw what is going on in the European Union, in China, and bring to the local law the good practices to understand and lay down the green taxonomy to help us to create a common understanding and create that kind of activities and assets that even the local or international players have a crystal clear understanding what kind of project can be adapt and named as a green inversion. Not just try to avoid the greenwashing and have a taxonomy for any kind of sectors and activities regarding the inversion that normally international players are demanding on that kind of projects.
Thank you, Felipe. And as a follow-up, so you were saying, very interesting. One of the questions I had for you as well was, why focus on green? We know that it's a trend. There's a lot of green taxonomies coming up. Why green? And are you thinking at some point to adopt a social taxonomy? And can I also get you in the same question for timing to answer to, can you tell our audience a bit about if you've met some capacity constraints while building such a big framework? It's a bit early to talk about lessons learned and what has that what does that create in the market, but perhaps about the process, like were your capacity constraints and how do you overcome them? So both, why a green taxonomy and what were some of the capacity constraints and on building it?
Sure, I think we started with a green taxonomy, but we are aware that the next steps are working on the social taxonomy. But we are not doing this by ourselves. We are looking up the good practices of different jurisdictions. We are asking for technical assistance. And what we saw around the world is the main countries working on taxonomy are doing first for the green taxonomy or environmental purposes and moving forward to the social approach. I think both of them are really important to develop for the private, for the public priorities in any country. And even for us, it's really important to work on social approach in education, in health. But we wanted to start from the same way that the other countries are working on. Now, yeah.
Can I cut you here? Do you expect a social taxonomy to be harder than an environmental one? And I mean, the answer can really be no, but I'm really wondering because we do hear that, sometimes when it comes to social, we have elements of culture, we have a bit of a more intangible assets there as opposed to environmental ones that may be easier to. So do you think it will be harder for you or are you not anticipating?
I think it's hard to say it right now. And I will say that it's part of kind of data that we can bring together and understand from the environmental or green perspective, but also what should be the right approach to the social issues. So when it comes to create or understand the relationship between a project and the social impact, it's too broad about health, education, even an infrastructure which pass around a small country, a small town, has an impact in all the people who live around it. So I think the huge challenge is try to measure the real impact on society when it comes about a project and asking for private or public investors to put their capital in that kind of projects. So let's say it's step by step. That's why we don't want to go at first to develop that kind of public policies, and we prefer to work together with international and multilateral perspective and technical assistance, and just work together with all the community working on it in the same way, asking, demanding the same goal.
Great. Did you want to speak about capacity constraints to finish off, or you think? Did you have any capacity constraints? The answer can be no.
No.
No? Very good. We're good. Okay. No, thank you very much. And I liked what you said last very much in the sense of working together. And in fact, it's going to be the theme of our very last segment here. So we reminded earlier that, of course, these legislations that are coming in from local and regional perspective, which is very important because they need to be taken into account the local fabric and the regional context, and they shouldn't just be, implemented in a vacuum. So we're very happy that we're seeing this. But at the same time, we do need to have a global, and we use this word interoperability, which isn't harmonization. Not everything has to be the same. It isn't standardization, but they need to be interoperable in the sense that, again, investors moving from one jurisdiction to the next should be able to fall back on some of the same requirements as a basis, and then maybe have some additional from some jurisdictions. So my question here, turning again to Priya, if I may, because we know that you have just adopted the Singapore Asia taxonomy and also worked with the preparation of the ASEAN taxonomy. So it's interesting to us to hear a bit about how will those two taxonomies, now that we've heard about what a taxonomy is, interrelate and be interoperable, if at all? And if you could tell us a little bit about the process behind building them.
Yep. I'll first touch on the Singapore Asia taxonomy. So that is fairly new. We just launched it late last year. And it sets out detailed thresholds and criteria for defining green and transition activities that contribute to climate change mitigation across 8 focus sectors. I think it's a significant milestone for us for several reasons. First, really, is that we're one of the first to globally pioneer the concept of a transition or amber category. And this really is in recognition of the need to properly contextualize transition for Asia, where in most cases we really cannot go directly from brown to green. And second is that this taxonomy has extensive coverage. It covers sectors making up about 90% of the region's greenhouse gas emissions. But finally, and I think what has really made this taxonomy really work is that it was industry-led. So, I mean, Maria, you're asking about how, the collaborative process was like. This taxonomy really draws extensively on the experience of financial institutions and real economy players who are engaged in transition activities in the region, right? We went through 4 rounds of public consultation before we actually managed to, tie everything up and publish the taxonomy last year. ASEAN has also been very proactive in terms of promoting sustainability and transition. And there was an ASEAN taxonomy board that was formed, and they worked together, the 10 member states, to develop the ASEAN taxonomy really to serve as a common language for sustainable finance in the region. It was also an iterative process with the taxonomy board publishing the 3rd iteration just last month after extensive stakeholder consultations. And how extensive I mean is, I think there were approximately about 160 different organizations that were involved in the stakeholder engagements, covering not just the 10 member states, but also stakeholders beyond the 10 Asian regions. So we've been talking a lot about how, all of this work that we're doing here, all that we're speaking about, really needs to be addressed collectively, not just within the region, but globally as well. We cannot be working in silos. And so the Singapore Asia taxonomy's green criteria is actually broadly interoperable with various global taxonomies. I'm sorry, I'm not sure where, how it stacks up with the Colombia one, but it's interoperable with at least the EU taxonomy as well as the ASEAN taxonomy. So what's interesting is the Singapore and ASEAN one both adopt a traffic light system. So there's green, there's amber for transition, and there's also red for ineligible activities. Right, and financial institutions and corporates in our region have the flexibility to reference, whether they want to use the Singapore taxonomy or the ASEAN taxonomy. So there's no, at this stage, there is no mandatory requirements on using it. But we hope that, as this guidance is laid out, it will be useful and helpful for players who are looking to transition. Right. So lastly, beyond ASEAN, we're also now working on mapping our Singapore taxonomy to the International Platform for Sustainable Finance's Common Ground Taxonomy, or the CGT, which many people already know or call it by, which currently covers the EU taxonomy and the People Bank of China's Green Bond endorsed project catalog as well. Right, and when this mapping is complete, I think financial institutions and market participants will be able to refer to this common set of definitions under the CGT, which will definitely help increase taxonomy-aligned financing solutions and facilitate sustainable development in markets which the CGT covers.
Thank you very much. There was a lot to unpack there, but thank you very much. And no, it was great to hear that all this work is going on, your involvement as well in all this work. I
guess the important thing is that all these taxonomies that are published, I think they're always going to be refined, right, as technologies evolve, I guess as we evaluate how all of us do as we approach 2030, 2040, 2050.
Great, thank you very much. Can I give the very last word to Laili? This is you'll have the very last remarks. It's more of a general question. It's a little bit about how do you see this the role of an agency such as UNEP-FI, but UN as a whole, to facilitate this dialogue, this interoperability, and yeah, I mean, what can you, I know that we had to discuss a little bit in the program about disclosure, which we haven't. It's a shame, but we're running out of time. If you want to integrate maybe about how you see this for disclosure legislation, but in general, how do you see the role, of the UN and our agencies to really help this global dialogue to avoid fragmentation.
The tough last remark. I promised myself I'll come and see how many times we'll say interoperability. I think we did a good job saying interoperability.
Wouldn't be a UN
I think I'm just going to touch on the two amazing points that were raised. And I think in terms of the UN system and broadly as a convening of member states in terms of speed and scale. So how can we get the conversation up to speed? And probably it connects to why did we start with green taxonomies? Not to make a plug from the UN environment perspective, but I think it's because of the systemic and science-based approach that we can't keep on emitting. Why is it easier? It's a greenhouse gas emission, one metric and you can go running. But that doesn't mean that the social taxonomy is not the next wave. How can you transition, have a just transition, and how can we align on the same words? That's where we get everybody into the same room. And that's why legislation is helping bridge that gap to get that speed and get that scale. But that doesn't undo the role of voluntary market initiatives, where they are leading that conversation, but also driving the disclosure from financial participants. And by disclosure and alignment, I think the major part that we're talking about here is impact, and we need to keep remembering that for the SDGs in particular, right? I think in terms of where the alignment comes is sort of saying where we need the money to go, right? But then when we're talking about disclosure and we're talking about measuring that impact, we're saying, how are we making sure that we're on the right track? And this is where disclosure frameworks are coming between the two concepts of materiality and double materiality. It's like, in terms of, as we said, about the broader picture of ESG, is like, am I looking inwards? And this is where we need to look outwards, and that's the double materiality concept, which was mentioned, integrated from EFRAG, from the EU and in China, and that's the emerging trend if we want to see money flowing towards the SDGs and SDG 14 and 15, also another UN environment plug, and the global biodiversity framework. But all of it needs to come within the social context of a just transition and leaving no one behind. And that's where impact mainly is hard to measure. We need to align on it, and that's where the Sustainable Summit next year, in terms of bringing us all together, where we can have more interoperability conversations about the topic. But I said it only 3 times, so I guess it's a good end.
You rose up to the task. Thank you so much. And I mean, really not much to add for my final remarks. I guess the very last thing, definitely Summit of the Future, FFD4, which is the Financing for Development Conference number 4, which we'll have in July next year in Spain. I think there'll be great platforms to have these types of conversations, to bring member states to the table, to say, how do we talk about these topics, double materiality? How do we make sure that we don't have a jurisdiction having one type and the other, and then, you know, we want to really avoid confusion and all go in the same direction. But thank you very much to our panelists. This was brilliant. Sorry that we were tight on time, but thank you very much. And thank you to everyone in the audience. So we did, yeah, I mean, let me give it to my colleague, Glenn, who will.
Yeah, thank you. I just was monitoring the Slido, and I don't think we have time to publicly address it, but I just wanted to bring those questions up now for our discussions in the break. And essentially, they had to do with, you know, this balance between time horizons, between short-term returns and long-term impacts, and how do we resolve that, particularly from a specific asset class perspective. So it was very much, you know, what are your challenges, Asha, being in equities, public equities investors, and making that balancing act? And Arsalan, how do you look at that for other types of investment engagements and asset classes that JP Morgan gets involved with? So I think let's bring those ideas into the conversation as we have coffee now. Just a short announcement that the coffee will be outside in the corridor along this east-facing wall. There are also restrooms on both east and west sides of the building if you need a health break. And we will be very excited to welcome you back in this room for the Transport and Logistics Investor Roundtable in about 15 minutes. So thank you.
Thank you. Really appreciate it.